Hey folks, don't adjust your camera. This is still me. I do know how to dress up.
You have socks on?
I don't, because I'm not used to doing this. We
Alright.
just talked about crossing legs, which I'm not very good
Here
at.
we go. We gotta get this far.
Okay.
Hello and welcome to Bearable Conversation with John and Jill at Reyes Group. I'm Jillian Seguin, Associate Wealth Advisor at Reyes Group at IA Private Wealth.
And I'm a very well-dressed John Reyes that works at IA Private Wealth as a wealth advisor at Reyes Group.
And
All the words were said, just not in that
Right.
order. And Craig got back on a plane to
Craig,
film this a second time with us. That's so impressive. You went home and came right back to film this second episode.
With my same outfit.
Craig, can't you just play along?
we changed seats. Anyway, once again, we are very pleased to have Craig Basinger here from Corpus Investments, Chief Market Strategist. And we pay you to come here? Or are you here on your own free will?
Listen, when I heard it was going to start snowing in mid-October, I said it's time to go visit my old home, Calgary. And I did live here. I went to grades 3 and 4.
Yes.
So
Yes.
Where?
it was on the military
It's close
base
to where I
next
live.
to where their pro-child.
But he did a
Highway.
really good segue, though. You just did a really good opportunity for us because this episode's going to be talking about political views and stuff. He didn't actually answer the question, if you notice, right?
What?
He didn't say whether
Oh,
he
yeah,
got paid or
where
not. He
he
just
was-
talked about it and he drove it like a politician would
Oh no,
over
no!
here, right?
I'm here for a few days.
There we go.
There
See,
we go.
still hasn't answered the question. Okay, on to this thing. Go ahead,
Okay,
Joe.
this segment, we're going to be talking about probably what most of you want to hear is Craig's intelligence and insight into the markets on various fronts. I think if we can just touch a little bit on the political situation, mainly the U.S. election. If you could talk a little bit on the inflationary environment, interest rates, and whatever else you think would be pertinent or what is maybe, I think these days, concerning investors.
In top of mind.
Yes.
Now, for the record, there was no monetary payment. They did give me a raspberry scone, and I'm not sure if that qualified or not, but it was good.
But can we just admit it?
Constituted
You got
contract.
half of the raspberry
Yeah,
stone.
that's true. The
because
dog
my
the
dog
dog ran off with the other
Came
half.
in and
Correct.
took the other half.
I've always had really small dogs. If it was up on a counter, it was safe. But apparently, if the dog's bigger, it's not.
There we
No,
go.
not here.
And by dog,
I'm-
you really mean a dog, not John.
I'm 53 and I'm still learning life lessons.
There we go.
This is what makes it all worth it. Listen, this has been a fantastic year for markets. There's no denying. I think it's just been a great environment in most markets. U.S. market, Canadian market now even is doing well. International bonds have done well. Cash has done well. I mean, I don't think people can complain about very much. But I think what a lot of people are wondering is why? And, the really key aspect here, in our view, the really big good news story is that inflation problem from 2002 and early 2003 has continued to move in the right direction. And let me tell you, the market hates inflation. We all hate inflation. I mean, we hate taxes, right?
Yeah.
And taxes, at least, a nickel for every dollar probably goes to do something productive. Inflation isn't. It is a tax on your wealth. It makes you less wealthy, and it's a very bad thing. Nonetheless, it has gotten a lot better. I'm not going to go into the causes, but it has been getting better, and that has been broadly good news for markets. And I think that's what's made markets so resilient that they've, increased geopolitical risk coming out of either Ukraine or the Middle East. Has been, obviously had a bit of a market impact, but very muted. And again, it's because of this better backdrop of inflation getting better and the economy still growing at a decent pace. And you put those two things together and investment markets do relatively well in that environment. So I think, if you want to take a step back and wondering why did this year turn out to be so good, and again, it's not over yet, but we'll just up until now, that is the key attribute. And truth be told, the economy, and I mean, everybody was jumping up and down, myself included. The risk of a recession a year and a half ago was very high. That has largely, at least, softened for the time being. And again, This is more good news. It's helping corporate earnings, and that helps the stock market move higher. Now, I will say there are risks out there. I would say one of them is, even though inflation is coming back down, and when I say inflation is coming back down, I'm not saying those prices are coming down. I'm just saying the rate at which they're going up is slowing
Decided, yeah.
pretty decently. But I will say, like, there are some signs, not in Canada, it's actually a better situation here. Inflation keeps moving much lower in Canada, where the US is actually starting to see some stabilization in pricing and some bit of an uptick. So that could be a problem in 2025, but for now, I don't think it's a big issue. The other big thing that's obviously everybody's talking about is the big election in the US. Obviously, that's kind of a market-moving event and very polarizing, what people think. I am not a political analyst. I have a firm belief that, one, we don't know who's going to win, which I think is a fair statement. And more importantly, you never know what policies they're going to enact, because they say things during the campaign season, and what actually happens when they take office is often very different. You've probably noticed that. And the biggest wild card out there, you never know how the market's going to react. What's priced in, what's not priced in, how the market reacts in one way or another call it like you're flipping 3 coins and trying to guess what's going to happen. And I think that's, from my perspective, why we'll pay attention to politics. Maybe we'll do a little bit around the edges, but really people shouldn't be changing their long-term investment strategy based on politics, because it comes, it goes, and really you never know how the markets are going to react.
Yeah, so not event-based investing, right? Like, just kind of what we said in the previous podcast was pick a strategy, have conviction, and stay with it. I guess I want you to comment maybe a little bit on how much cash is still on the sidelines and how that can either help or hinder the markets going forward.
Yeah, that's an interesting one, because again, we've obviously been living in a very low interest rate environment up until the last few years, and as a result, cash didn't pay anything for the longest time, or paid very little, and then all of a sudden it started to pay quite a bit, and all this money flowed into cash or cash vehicles, and the question is, where does that money go? And the problem is, it's not necessarily into the market, because a lot of people who are sitting there going, hold on, my bank account is paying me 1% or 0.5% in my checking account, where all of a sudden I can move it into an investment account and buy high interest savings ETF or something like that and actually earn a lot more. So a lot of the money that actually has flowed into cash probably isn't market risk money. It's just, it went there for the higher yield, and that doesn't mean it's going to pile into equities or the bond market. But I will say we have seen, that's a chunk of it, but some of it has been. And what we've been seeing is it has started to move into bonds more often than anything else. And I think what a lot of people are thinking is, like, I've been earning, a decent income with my cash vehicles, but now Bank of Canada's cutting rates, the Fed's cutting rates, the ECB's cutting rates. Everybody's cutting, not everybody, but most of the banks are cutting overnight lending rates, which means that yields on cash are going to start coming down. And I think people are sort of being a little bit more active and buying more into the bond market, and that's where we've seen flows move.
Or into the dividends?
And as a further iteration from that, some of the money has been flowing into dividends as well. But I think a lot more of it's going into the bond market right now, as people want to sort of lock into some of these higher yields in case the overnight rate keeps moving lower.
Spot on. I think we were making these purchases here over the last, I wouldn't say couple of weeks, into that bond space. And I think that a lot of times, that flow of capital, people believe that, and I don't know why, but a lot of people believe that, fixed income is equal, meaning GICs are the same as money markets, are the same as bonds, and they really aren't, right? And I think that shifting of capital to bonds is a demonstration that, we're getting back to, God, I hope I'm not right in this, but the 60-40 split might be starting to come back in terms of people's desires and how they want to manage their money. Any comment on that in terms of, is that something that you believe is coming back? Like, I personally hope not, but
I'm just going to say it never went anywhere. I find it really, I know our industry talks about it quite a bit, and the 60-40 is, just the kind of putting a plain vanilla on portfolios, going 60% equities, 40% bonds, off you go, and in
For the record, I don't believe in it, and I don't think it. So I'm with you, and I just want to hear your comments.
It's not a unicorn.
Yeah.
So it does exist.
Yeah.
But nonetheless, I mean, the 60-40 portfolio, a lot of people sort of harped on the 60-40 portfolio because of 2022 when bonds fell at the same time as equities fell, and that was a very challenging, bad year for that sort of plain vanilla portfolio allocation. But I'll be honest, like that sort of asset allocation, that's what drives portfolios. Now, you can tweak them around the edges, and you can have different kind of diversification tools, you can have different kind of alternatives, and you can lean into other factors and sort of nuance a portfolio. But at the core, a portfolio is primarily driven by its asset allocation mix with some nuances, and I don't think that's changed. I mean, 2022 was a challenging year because both those core building blocks for portfolios went down in the same year, and that does happen. It does. I mean, that's just part of life. Just like markets don't go up every year, sometimes they go down, and sometimes they both go down together. And that's just, I think, part of investing. These things happen. I don't think it's actually refuted the traditional approach to building portfolios. I will say, though, there are some nuances that have changed. One of them is, it has become harder to find diversification in this market. So on the downside, I think we're back into an environment where bonds and equities actually move more in unison than they did over the last 20 years. That's a much longer story on why that dynamic, I believe, has changed, but I think that's what we've gone back into. It's not abnormal. It's been a while. And I think that's created an environment where it's just harder to find diversification. And so I think people need to sort of look for different sources of diversification, but still the core building blocks are still there. People still need to own equities, they still need to own bonds, and then still get a bit more creative on how you find diversification, because we've moved into this world it's just harder to find. That's the bad news. There's good news.
Good. I was waiting for it.
Those bonds that didn't used to yield anything before, that you used to just own in a portfolio for that stabilization factor, which again failed in 2022. But they might not be as great a stabilizer as they used to be in past years, but they now yield a lot more. So they're now an actual positive return contribution to a portfolio. And this is good news. So, nobody ever said investing was going to be the same every year, year after year. In fact, I think they've said it will be different every year. Mm-hmm. And that does make it more challenging. But again, you build resilient portfolios. Markets evolve. They don't completely change, but markets evolve and tools evolve, and you can build better portfolios as things evolve. But again, being forward-looking with portfolio construction and designing things for sort of the next 5 years and having that long-term view, I think, is crucial. And I don't think that's changed. I don't think that'll ever change. I think that'll continue to evolve as we move on.
Can you, I think we've all seen the markets definitely in the last 2 years, maybe even 3 years, been pretty strong. And a lot of that has come on the back of technology and AI specifically. And we looked at I think it was about last year, this time we were looking at the S&P 500, and it had been very strong, but really only six stocks in that S&P 500 had pushed that index higher. And the rest of them, 494, were either flat or marginally up or down. What's your outlook on technology? Has it run its course? Are there other ways to integrate technology into another sector for investing? Specifically, we've been looking at the health sector and how technology has been kind of impacting some, or maybe bolstering some of the equities in that aspect. I guess just speaking on technology and AI in general.
Yeah, listen, technology companies today are pretty exciting. The AI change or evolution, it's not anything new. Listen, you've been doing coding 4 or 5 years ago before AI became it's just become more popularized because of large language models. But nonetheless, it's, the technology behemoths at the top of the market right now are still big, they're still growing, and that's decent news. But I would say the concentration in the US market is very high, which adds risk. Now, it could keep going a year, 2 years, who knows? But the risk in that market has become certainly much more elevated because of the concentration in those mega cap names that are predominantly technology focused. And I think that adds risk. And that's just the way it is. I think that people should sort of mitigate that risk if they can, depending on their risk appetite. And I think that's the environment we're in. I think we use a little bit more on the equal weight side as opposed to the cap weight, which sort of immunizes that risk to a certain degree. And I think that's a more prudent approach in this environment because of that concentration. But, I would point out, the broadening of the market, those other names beyond the mega caps, they've actually started to perform much better over the last, call it 6 months, and we've seen broadening out of the market. And I would also point out when financial conditions ease, which is the Federal Reserve cutting interest rates, that is very often a time when you see the more broadening of a market. So again, I think from a risk perspective, there's a few things at play here. I don't know if they'll keep going. It's exciting, but it's also certainly a lot more risk.
Shifting to from markets now to politics, right? I think in our last podcast you indicated that one of the things that markets, and I know we like using markets like it's a living being, but markets, what they don't like are uncertainty, right? And again, I'm not trying to pull you into being political junkie or anything like that, but it doesn't seem like there's going to be a clear-cut winner in the U.S. elections. At least that's how I'm seeing it. Would that not lead to uncertainty if on election night the possibility of
A
not
hanging
decisive?
I get it. Yeah.
And what could that
the Feds
be,
are
right?
meeting the very next day, right? On
Yeah,
November
isn't that
6th.
kind of how it all goes, right? So, any comments on that, like the uncertainty?
You know what? Listen, there is uncertainty. There's always uncertainty. That's why the markets are the markets. That's why they actually move every day.
Yeah.
But nonetheless, I would point out, yes, you are correct. I mean, one of the big concerns, I guess, out there is that we have a contested election. Again, the election is November 5th. It's not till January 20th. They actually have to name a new president. There's that wiggle room in the middle that you can get court cases, et cetera, et cetera. Would that be a negative for markets? Probably. But I would also point out everybody is sort of expecting that, talking about that. And let me tell you, the one thing I do know, market doesn't like surprises. If everybody is running around going, even if Harris wins, it'll get contested, it'll go to the Supreme Court. Even if Trump wins, it's good, like the fact that everybody's saying it very often immunizes with how the market's going to react, because it's like, oh, well, we expected this anyways. It's not going to react all that much. But you never know. Certainly going to be interesting. Certainly will probably add volatility in one direction or the other. But again, who knows?
Who knows?
How about in Canada? There's more political instability now. We're hearing more and more. Even BC, the election in BC is questionable. And how is that impacting, investment in Canada?
I don't think it does all that much, to be honest.
Okay.
Yeah, we think our politics are exciting, makes the news, but doesn't propagate out very far. So I don't think it moves the Canadian market very much. I think the Canadian market's been doing well over the last 3 months because there's been increased flows from outside investors for whatever reason. Maybe it's because the dividend factors become a bit more in vogue because the yields have come back down. But nonetheless, I mean, I don't think it's a politics thing. I don't think it moves markets.
We want to believe it is, but the reality is we produce oil, we produce gas, we produce wheat, lumber. We're a commodities-based country, and we go with, general economic trends, right? I think
more on the global economy matters more for the Canadian market than anything else. Yeah.
And that's not that we don't share strong opinions or not, but it's just not for the purposes of what we're looking at from this standpoint. Anything else we want to cover, Jill? Or I think, is there...
Well, I could go on all day, but...
I know you can. But remember,
lots of questions.
you have to watch... I think that was in the last one, right? So if you watch CNN, you want to watch a little bit of Fox. And if you watch a little bit of Fox, you want to watch CNN. But what if all you do is sit there and just watch that on repeat? Craig, what if you just watch all day CNN and then all day Fox in front of your TV? Like some people...
There's another element to that. It drowns out other people's voices that might be in the office.
Or maybe just go with TikTok.
Okay.
That's what I think we'll do. That's how we'll, guide ourselves.
Oh, thank you. Sorry.
Thanks for having me.
Thank you so much.
Yes, thank you, Craig.
Yeah, if there's nothing more,
No, I think that's it. We can sign off.
Sign off.
Simon, that's 2 in a row that we haven't fought, buddy. 2 in a row. Good
Just wait,
stuff.
Christmas is coming.
Yeah.
Thanks, everybody.
Thank you.
Thank
As a young man, heard the sky's the limit. First thing first, I'ma break through the ceiling. One life jam, but it feels infinite. One life jam, then I better.
This information has been prepared by John Reyes, Wealth Advisor, and Jillian Seguin, Associate Wealth Advisor for IA Private Wealth Incorporated, and does not necessarily reflect the opinion of IA Private Wealth. The information contained in this video comes from sources we believe reliable, but we cannot guarantee its accuracy or reliability. The opinions expressed are based on an analysis and interpretation dating from the date of publication and are subject to change without notice. Furthermore, they do not constitute an offer or solicitation to buy or sell any of the securities mentioned. The information contained herein may not apply to all types of investors. The wealth advisors can open accounts only in the provinces in which they are registered. IA Private Wealth Incorporated is a member of the Canadian Investor Protection Fund and the Canadian Investment Regulatory Organization. IA Private Wealth is a trademark and business name under which IA Private Wealth Incorporated operates.